Hello, this is Nick Rach with the Earnings Scout, and today I'm going to review fourth quarter 2016 EPS guidance, as we've had 25 companies already in the S&P 500 report results classified as third quarter 16. Let's take a look at how fourth quarter estimates are changing, the growth estimates, and what that's going to mean for markets. As we look at how the fourth quarter estimates have changed since March 1st, we've seen them come down ever so slightly from March through the beginning of September. And then in peak pre-announcement earnings season in September, we saw something that's pretty atypical. Now, typically in pre-announcement season, we see more companies lower estimates and the numbers come down. But actually what happened is the growth estimates for fourth quarter 2016, which we have been saying are high, went higher during the month of September, up to 6.29%. Now, last week, the estimates did come back down a little bit as some companies in the S&P 500 have been reporting their results. We're seeing, once again, a majority lower their estimates, so the numbers are coming down to 6.17%. That's where we're currently at. That is fourth quarter 16 versus the fourth quarter of 15. Now, that growth estimate is much higher today than what it was a year ago at this time. And this is what we're going to use to say growth is going to reaccelerate. And as you know, we've been saying since March, when we upgraded equities after being bearish on them for the 15 months prior to March 2016, we said that the first quarter of 2016 was going to be the low water mark for EPS growth for the S&P 500 and the Russell 2000. We have been correct because second quarter growth was better than first quarter growth, and we're telling you the third quarter will be better than second quarter, and the fourth quarter of 16 is going to be even better than this upcoming third quarter earnings season. Why do we say that? Now, one of the reasons is because we're looking at the revision trends. Another reason is because we're going to show you comparable point in time estimates for those growth from the consensus. Here's the 6.17% growth expected for fourth quarter 16. We just showed that on the screen. Now, if we go back a year ago in time to just before when third quarter 15 earnings season was going to peak, the fourth quarter 15 growth estimate was only minus 0.16%. So you can see the growth estimates today for the fourth quarter upcoming much better than they were last year at a comparable point in time. The first quarter 17 estimate today is 12.58%. The year ago number was only 5.27% for the first quarter of 16. So significantly better growth is expected for the first quarter of 17 today than what it was comparable last year at this time. And you can see second quarter growth at 8.58%, better than the 5.9% expected for the second quarter. So the bogeys are higher. That means growth is going to reaccelerate. That's the good news. The bad news is the S&P 500 is up 18% over the past 7 months. The Russell 2000 is up over 30% over that same time frame. That means the market has been already pricing in this reacceleration. So the good news is the higher expectations are going to mean higher growth, but when we look at this, the hurdles that corporate CEOs are going to have to clear versus this year versus last year, here's where the hurdles were last year. Pretty low expectations. The hurdle rate this year, much higher. So we have higher expectations this year. It's going to be harder for the markets to clear some of those in the weeks ahead. And now let's talk about central bankers, which really have been pulling the strings on these expectations. A lot of people, they think they've been the reason markets have been going higher. We're saying it's not the reason alone. Central bank action is the reason markets are going higher, but it's how they've been dictating the expected profitabilities of major corporations has been what's been taking the markets higher. But let's not forget, on December 3rd, Mario Draghi turned into Ebenezer Scrooge when he failed to deliver enough stimulus in early December. The markets were expecting more stimulus out of the European Central Bank. They didn't get it. Then on December 16th, 2015, the U.S. Fed raised interest rates by only 25 basis points. We realized only 25 basis points isn't a lot. It was the first hike since 2006, though, and those interest rates killed the rally in stocks. So then let's take a look what was going on, because markets were rallying in October, in November, ahead of those ECB actions and the Fed actions last December. But take a look at peak second quarter earnings season. What we're showing you here is an earnings score where we're measuring the rates of change to the S&P 500 EPS expectations, and in peak second quarter 2015 earnings expectations, as companies were reporting their second quarter earnings, their overall expected profits were falling by 1.89%. So the analysts were cutting the estimates in peak earnings season by 1.89% for the future. In third quarter peak earnings season, which peaks in mid to late October, estimates were falling by a rate of 2.75%. So the ECB in December, after estimates are coming down at increasing rates from the second quarter to the third quarter, failed to deliver enough stimulus, and the Fed tightened into a situation where earnings estimate trends were deteriorating. When they took that action in December, what they did is they intensified the global sell-off to begin this year, because in peak fourth quarter earnings season of 2015, estimates were falling by a rate of 3.98%. So that was a trend here that you could see when the estimates are falling at increasing rates. This is why 2016 started off the year so horribly. In fact, if you recall, a lot of people are already forgetting because it's an up year for stocks this year. They forgot that we began the year with the S&P trading in one of the worst starts ever in 100 years. So as we see those estimates coming down by a rate of 3.98%, the ECB and the Fed realized, in early March 2016, the ECB decided to increase its stimulus, and the Fed said, okay, we thought we were going to hike rates in 2016. They have refrained from hiking rates and adopted a lower for longer strategy. When the two central banks did this, then in first quarter earnings season, what it did to the expectations as companies reporting their first quarter earnings, what they were saying about the future, the estimates were then falling by a rate of 1.54%. And in peak second quarter earnings season of 2016, which peaks towards late July of 2016, the estimates were only coming down by 1.32%. So a lot of people have been saying with the market rallying 18% as earnings estimates are falling, and we got negative earnings scores on the screen here. That means the magnitude by which estimates are falling when they're negative is estimates falling on an absolute basis. But take a look at the magnitude by which they're falling. When they're falling at increasing rates, stock prices fall. And when the estimates fall at decreasing rates, the delta is positive. What we see here is stock prices go higher. So the market is not disconnected from earnings. We can show you here when we draw on the trend lines, stock prices are doing what they should. They're following the deltas to EPS expectations. Now, one thing we want to show, now that we showed that stock prices are following the delta to expectations, where are those growth expectations? When we mentioned the fourth quarter, but we want to show you where the growth has been and where it's expected to go. So we have all this weak and or negative EPS growth in 2015 and 2016. Let's not discredit that growth has been very persistently weak, if not negative. And then all of a sudden, boom, fourth quarter 16, first quarter 17, those expectations look pretty high to us. So growth is set to rapidly reaccelerate, kind of out of the blue, at a time when central bankers could repeat their mistakes of last year, because there's talks of an ECB taper back on its bond buying program. And this is one reason why the market has rallied, because they increased stimulus in March of 2016. And the Fed is now thinking of hiking rates again. In fact, there's a 65% chance in the market that there will be a rate hike in December. So it could be deja vu all over again, because the likely path of EPS expectations that we've been measuring, this improvement ever since those stimulative initiatives taken by the central banks in March of 2016, which saved the day and saved the markets from their atrocious 2016 start. The likelihood is what we're seeing here is a path that we could see the deltas to earnings expectations start to go south again. Why? Because the bogeys are high, and the central banks could repeat their same mistakes. Now, if we are wrong and we don't see these deltas turn negative and we see the early measurement of the companies hold up, that means growth is set to rapidly reaccelerate. And we think there's at least 10% more upside in the market if the estimates can be maintained, because it would be on the improving path and growth would be, we want to say exploding, but it would be getting back to above trend. That would be a great scenario. We say that's an unlikely scenario. The more likely scenarios we see the deltas start to turn negative here, and we could see the increased chance of a pullback. So we want you to take a look at this market equation heading into 2017. We had a weak September jobs report. We have a Fed that's intent on raising rates. We have, as we showed you, high first half 2017 EPS expectations. And the S&P's 18% bounce since February 11th. And again, you have the Russell 2000 up even more than that, up over 30%. So what do these all variables add up to? We think of an increase in chances of a pullback. Now, we are still neutral on equities, meaning we're saying maintain your normal allocation to stocks at this point, but our finger's on the trigger to sell. What will take it off, what will allow us to pull that trigger? We're going to look at the data that comes in. And these are the companies reporting this week. We're going to be looking at not just what they say about the third quarter. We don't care about that. But we're going to be looking at what they say about the expectations and see if those underlying earnings expectation trends that we've been measuring since the fourth quarter of 2015 period can continue in this direction. The variables added in would be the central banks tightening, if you will, by the ECB tapering or the Fed tightening, and what that would do to economic expectations if they turn south. Given this run up to the market, we think the chances of a pullback here would definitely increase. So that's our view of what's going on with fourth quarter estimate changes as companies report their third quarter earnings. We update these numbers every day for our clients with daily commentary. In our database too, you could see the trends not only for the overall markets for the S&P 500, we do this for every sector, every industry, and for 4,500 domestic and international companies. We don't care if earnings estimates are going up or down. We just care if the expectations are getting better or worse and if they can be sustained. So if you're interested in learning more, contact our sales and marketing team here at their contact information on the screen, or contact us at sales@earningsscout.com. And happy trading this week. Thanks for listening.